This is a video for Finance 303 with Professor Dow, and I'm Jim Dow. In this video, I will introduce some basic elements of financial forecasting and how they connect with the financial plan. In this presentation, we will focus on some basic techniques and principles used in forecasting, with a particular emphasis on financing asset purchases. The pro forma financial statements in the financial plan will include forecasts for a number of different items. The cash budget will have forecasts of cash flows to show that we will have enough cash on hand. The financial plan will indicate if there will be a need to raise money in the future and how it would be raised. Finally, there will be forecasts of future earnings to show whether asset purchases can be funded internally and whether any money borrowed externally can be repaid. We will start with an example of a small company, Bay Cities Granola, a manufacturer of gourmet granola, that expects its business to grow over the next few years. We can think about the forecasting process proceeding in several steps. First, we will forecast how fast sales can grow over time. This will be done in the business/marketing part of the business plan. Next, we will need to determine how much additional assets we will need to support this growth. Finally, we will look at how those assets will be financed. The simplest approach to financial forecasting is the percent of sales approach. There are a variety of problems with this approach, which we will discuss later, but it provides a simple starting point for understanding financial forecasting. The first step is to make an assumption that sales will grow at a certain rate. Ideally, this is based on a detailed market analysis, including consumer demand and competitor behavior. Everything else on the income statement and the balance sheet are assumed to grow at the same rate as sales. Since costs will increase at the same rate as revenue, the profit margin will remain the same. It's assumed that the firm will need more assets to support the increased sales, and the amount of assets will increase proportionally and evenly over the years. Finally, it is assumed that the capital structure will remain the same, so that liabilities and equity will increase at the same rate as assets. This assumption generally works best for large established businesses, but it also provides a place to start for small businesses. Here is a simple example of using the percent of sales approach to forecast financial variables 1 year out, 2016, based on the previous year, 2015. The income statement items are at the top and the balance sheet items are at the bottom. Revenue is assumed to grow by 20% and everything else grows at the same rate. Since assets, liabilities, and equity all grow at the same rate, this leaves the capital structure, the share of assets financed by debt and equity, the same. At this point, the forecast does not specify where the company will borrow the additional money or how it will increase equity. In a prior presentation, we saw that a business plan includes an investment plan that shows how much and what kind of assets the company needs to acquire, and then a financing plan which sets out how those assets are paid for. That is, how will the company raise the money to purchase the assets needed to expand its sales. The previous slide set out the numbers for both parts of the plan. The company would need $30,000 more in assets, that's the investment plan, and would raise $10,000 by debt and $20,000 by equity. That's the financing plan. There are a variety of problems with the assumption that everything increases at the same rate as sales. While it might be reasonable that variable costs increase at the same rate as sales, fixed costs won't. And that's why we call them fixed. And so our forecast would likely overestimate future costs. A more realistic assumption is that assets, machines, buildings, etc., are lumpy. That is, they come in fixed sizes. So it's unrealistic to plan on increasing everything by a fixed percentage each year. If you have a warehouse, how do you increase your warehouse size by 3% each year? You might either have to buy a new warehouse in year 1, which would provide you with more capacity than you need, and a greater need to raise funds at the start, or you may have to delay your purchase of a new warehouse, which would slow the growth of sales. Finally, most companies don't raise money by increasing equity and debt at the same rate each year. They might have preferences over how they'll get additional funds, or want to focus on raising money through one source at a time, perhaps due to fixed costs of issuing new debt or equity. We will discuss this more later in the presentation. If the assumptions behind the percent of sales approach are not good approximations, we will need a more complicated model. This may include making separate forecasts for fixed and variable costs, where fixed costs are unchanged and variable costs increase at the same rate as sales. Or being specific about when assets are purchased and how big each purchase will be, rather than assuming that the amount of assets increases smoothly. Finally, we might want to specify how the money will be raised following the guidelines laid out in the financing plan. Let's think some more about the sources of funding in the financing plan. As mentioned on the previous slide, the financial forecast can specify how the company will choose to raise money. There are basically three options. The firm can use debt, that is, borrow money. The firm can issue new equity, or the firm can reinvest earnings, retained earnings, which is just another type of equity financing. We'll discuss the theory behind choosing the best capital structure in a later lecture. But one common approach is that firms prefer to raise funds in this order. First, internal funds, which is retained earnings. Then second, external funds, with a preference for issuing new debt before new equity. Of course, there are many exceptions to this, but it gives us a place to start. We can use these guidelines when making our forecasts by first determining the amount of money being raised, and then by assuming that we will first use any earnings available. If there are not enough internal funds, then the remainder would be raised by external funds, first with new debt and then with new equity, subject to any constraints on the targeted capital structure. In practice, there is a back and forth between the investment plan and the financing plan. If the initial forecast shows that the firm would have to obtain external funds, management may instead scale back expansion plans to avoid having to issue new debt or equity. Then the forecast would have to be redone with the new sales assumptions.